A notice quietly appeared on the Commodity Futures Trading Commission website. Almost no one noticed it. It was published after the market closed, buried deep in the regulatory announcements section, yet the headline alone should have set off alarms everywhere. An emergency commission meeting was scheduled for February 2, 2026 at 9 a.m. in a closed session. The stated agenda, market stabilization measures for the precious metals complex. Translated from government language, that means the rules are about to change to protect the banks. I've followed the silver market for many years. I've witnessed manipulation, suppression, and every strategy imaginable. But I've only seen this particular maneuver one time before. In 1980, when the Hunt brothers attempted to corner the silver market, the CFTC stepped in with liquidation-only trading. Opening new long positions was banned. Selling was allowed. That single rule change wiped them out. Silver collapsed from nearly $50 down to around $10. And now, 4.5 decades later, the same playbook is being dusted off. That Monday morning CFTC meeting isn't a debate. It's a verdict. The decision has already been made. By Monday afternoon, buying silver on the COMEX could be restricted. By Tuesday, similar limits may hit ETFs. In this video, I'll break down exactly what's coming. I'll walk you step by step through the 1,980 blueprint they're following almost word for word. I'll also explain why this emergency meeting is actually evidence that we're winning, not losing. And I'll outline precisely what matters most over the next 72 hours before the door is slammed shut. This is the system pushing back, and preparation matters. Let's look at the notice itself, because the wording is critical. The CFTC announcement posted on January 30th at 5:30 p.m. states that the Commodity Futures Trading Commission will hold an emergency meeting on Thursday, February 2nd, 2026 at 9 a.m. Eastern Time to address urgent issues related to market integrity in the precious metals futures market. Now let's rewind to 1,980, because this is a real precedent, not speculation. We've already watched this scenario play out. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, were Texas oil billionaires. In the late 1970s, they became convinced inflation would destroy the U.S. dollar, so they turned to silver aggressively. By 1979, the Hunt brothers and their partners had amassed roughly 200 million ounces of physical silver. Silver surged from roughly $6 in 1979 to nearly $50 by January 1980. The Hunts were making billions, while the banks that had shorted silver were bleeding money. Institutions like J.P. Morgan, Chase, Engelhard, and Makata Metals were heavily short and staring at insolvency. So they turned to their allies in Washington. On January 7th, 1980, the COMEX Board of Governors called an emergency meeting. The very next day, new rules were rolled out. They were labeled Silver Rule 7. The policy enforced liquidation-only trading. Effective immediately, traders were allowed to close positions, but forbidden from opening new long positions. Selling was permitted. Buying was not. This single regulatory shift fundamentally altered market dynamics and removed all upward pressure from silver prices almost overnight. The consequences were swift and devastating. If you're long silver and barred from buying to roll positions forward while everyone else is forced into selling, the price has only one possible direction: lower. Silver collapsed from around $50 in mid-January to roughly $10 by March. That was an 80% plunge in just 6 weeks, wiping out fortunes across the market. The Hunt brothers lost more than $1 billion and ultimately declared bankruptcy. The banks, meanwhile, survived. The justification from the CFTC and COMEX was market manipulation. They claimed the Hunts were creating an artificial shortage and engaging in disorderly buying. But that explanation leaves out the core issue that truly destabilized the system and forced regulatory intervention. The Hunts were purchasing a real physical commodity in a market where banks had sold far more silver on paper than actually existed. When the Hunts demanded delivery, the banks couldn't meet it. So the rules were rewritten to protect the banking system. That isn't a free market. It's a rigged one. And the same playbook is being reopened today. The parallels today are striking. In 1980, the Hunt brothers accumulated about 200 million ounces of silver. In 2025, open interest across silver futures and options represents roughly 700 million ounces. Banks are again heavily net short, inventories are tight, prices are surging, and an emergency meeting is scheduled. The calendar has changed, but the mechanics remain the same. The banks are cornered, the government is stepping in, and retail investors are at risk of being crushed unless they understand what's coming and prepare accordingly. Here's what I expect to be announced Thursday morning. Let's start with the most likely action. Measure 1 is liquidation-only status for large speculators, barring new long positions while allowing reductions only. They'll be allowed to sell or let contracts expire, but they won't be allowed to buy more. That restriction alone forces large long positions to unwind. Measure 2 is a sharp increase in margin requirements, potentially to 100%. Right now, holding a silver futures contract requires roughly $10,000 in margin per contract, but that figure could be raised dramatically. That figure could be raised to $50,000 or even the full notional value of the contract. This effectively eliminates leverage. Traders who rely on margin won't be able to maintain positions and will be pushed into selling through margin calls. Measure 3 involves slashing position limits to around 500 contracts per entity, forcing immediate liquidation. At present, silver position limits sit near 6,000 contracts. A reduction of this scale would instantly force large players to liquidate excess exposure. Now let's address the legal foundation because this is critical. How can the Commodity Futures Trading Commission simply ban buying? Doesn't that violate free market principles? In practice, yes, but legally the agency has cover. The Commodity Exchange Act grants the CFTC sweeping emergency authority under Section 8 and 9. If the Commission determines that an emergency exists that threatens orderly commodity trading, it can act. The law never clearly defines what qualifies as an emergency. That determination is entirely discretionary. Once an emergency is declared, temporary trading restrictions can be imposed without congressional approval. There's no requirement for public comment, no extended review, and no meaningful due process. These measures can remain in place for up to 120 days and can be renewed. This is the same legal weapon used in 1980, and it's the same one likely to be deployed again. Courts almost always defer to the agency once an emergency declaration is made. You can file a lawsuit, but history shows you won't win. The Hunt brothers tried in 1980 and they lost. The precedent is firmly established. When regulators decide to tilt the playing field to protect the banking system, they have both the authority and the institutional backing to do it. Here's how the timeline likely unfolds after the announcement. Thursday, December 19th, 9:02 a.m. The CFTC meeting begins in a closed session. No media, no public access. By 10:30 a.m., the meeting wraps up. Shortly afterward, the CFTC chair releases a statement approving emergency measures effective immediately. Position limits are reduced, margins increased, and large speculators are barred from adding long positions. By 11 a.m., CNBC breaks the story, framing it as prudent oversight. By 11:30, silver futures gap down sharply as forced liquidation begins. Around noon, retail panic sets in. By 2 p.m., silver closes near $50, down nearly 19% in a single session. Options expire, worthless banks are rescued, and the squeeze appears dead. Or so they want everyone to believe. Here's what regulators aren't factoring in. The physical silver market doesn't answer to CFTC rules. This sets the stage for a major split, the great decoupling that's about to unfold. The Commodity Futures Trading Commission can dominate the COMEX futures arena, prohibit buying hike margin requirements, and force liquidations. But COMEX is only one venue. It is not the entire silver market. Silver trades across multiple global channels. It trades in London through the London Bullion Market Association. It trades in Asia on the Shanghai Gold Exchange. It trades over the counter between private counterparties. And it trades physically at coin shops and bullion dealers worldwide. The CFTC has no authority over those markets, and it cannot control price discovery outside its jurisdiction. So what happens when liquidation-only rules hit COMEX? The COMEX price collapses because selling is the only permitted action. But prices in London, Shanghai, and the physical market don't fall because buyers there are still free to buy. In fact, demand intensifies as market participants recognize the disconnect and rush toward venues where real metal can still be obtained. Industrial users can't depend on COMEX for supply anymore. They pivot to London and Shanghai, sourcing metal directly from dealers and wholesalers. That surge in demand outside COMEX drives prices higher in those venues. The paper market weakens while the physical market tightens, accelerating the separation between futures pricing and real-world supply conditions across the global silver trade. The result is a clear divergence. COMEX silver might trade at $52, London at $66, Shanghai at $72. Physical dealers ask $80, four prices for the same metal. This is physical backwardation. It's the market signaling that the paper price no longer reflects reality and that confidence in futures-based price discovery is breaking down rapidly. Once the decoupling takes hold, COMEX loses relevance. Miners won't sell silver at $50 on COMEX when they can get $72 in Shanghai. Deliveries to COMEX dry up. Inventories bleed toward zero. The exchange turns into a hollow marketplace, paper claims detached from physical supply. Regulators believe they're stabilizing the system. In reality, they're dismantling it. That brings us to the next 72 hours. This is the final window before the rulebook changes. If you hold silver futures on COMEX, you have three paths. Option A is to exit now and lock in gains before restrictions land. Option B is to stand for delivery demanding metal instead of cash settlement. Option C is migrating exposure offshore. Action 2 applies to ETF holders. If you hold silver ETFs like iShares Silver Trust, take this as a serious warning. Once restrictions are announced, ETFs could pause redemptions or even halt trading altogether. Liquidity can vanish quickly when underlying futures markets are distorted, leaving shareholders exposed to price gaps and forced repricing. We're already seeing signs of strain in iShares Silver Trust. Upcoming rule changes could provide the perfect justification to freeze the fund. If you're holding SLV, the choice is simple: exit now or accept the risk of being locked in. That decision is yours, and it carries real consequences once restrictions are announced and normal redemption mechanisms are no longer guaranteed. Action 3 focuses on timing physical purchases. If you're holding cash and planning to buy silver this weekend is critical Saturday, Sunday, or Monday morning before the meeting. Visit your local coin shop or order online from major dealers. Buy whatever you reasonably can because normal premiums are unlikely to survive beyond the next few days. By Thursday afternoon, one of two outcomes is likely. Either panic buying overwhelms dealers and inventories vanish, or dealers move first and sharply raise premiums to $20, $30, even $40 over spot. In either case, this weekend represents the last realistic opportunity to acquire physical silver under anything resembling orderly market conditions. Action 4 is about conviction. If you already own physical silver and you're considering selling, pause. What's about to unfold validates the original thesis. Government intervention is not a warning sign, it is confirmation. Rules are changing because shortages are real, banks are cornered, and the system is under stress. You don't abandon a winning position at that moment. Now let's walk through 3 possible paths over the next 2 weeks. Scenario 1 is the crash followed by recovery. On Thursday, restrictions are announced and COMEX silver drops sharply. Retail panics and headlines declare the bubble burst. Within 48 hours, physical buyers step in and real-world prices begin to disconnect from paper futures. In Scenario 1, industrial users realize metal cannot be sourced at depressed paper prices. Physical bids rise sharply, Shanghai opens higher, and by early January the decoupling is undeniable. COMEX trades near 50, while physical silver approaches 85. Miners stop delivering, inventories dry up, and the exchange fades toward irrelevance. Pain comes first, validation follows. Scenario 2 is global spillover. Other nations interpret U.S. restrictions as financial aggression. China bans silver exports. India raises import tariffs. Russia announces national stockpiling. Resource nationalism spreads rapidly. By New Year's, silver trades far higher in Asia and Europe than in the United States, and the dollar's role in commodity pricing begins to erode. Scenario 3 is full-scale intervention. After a COMEX plunge, emergency powers are invoked, silver is declared a strategic material. Domestic production is allocated, and civilian purchases above a threshold require approval. This creates a framework resembling confiscation. It is extreme but historically precedented and represents the worst-case path if control efforts escalate further. Next comes the psychological campaign. The rule changes are only the opening move. Media narratives, expert commentary, and official statements will attempt to shape perception, suppress confidence, and convince holders they were wrong. Understanding this phase matters because emotional pressure is often more powerful than regulation itself, enforcing capitulation. The second move will be a coordinated media offensive. Starting Thursday afternoon, immediately after the announcement, expect a synchronized messaging blitz. Outlets like CNBC, Bloomberg, and the Wall Street Journal will push the same storyline, regulators stepping in to protect retail investors from a silver speculation bubble, preventing another meme stock-style frenzy and curbing prices. Portrayed as unsustainable, economists will be paraded across screens claiming silver fundamentals do not justify prices above $60. Charts will compare silver to historic manias like tulips.com stocks and GameStop. Commentators will argue the rally was driven by conspiracy theories and Reddit-style manipulation, not real demand, framing the move as reckless speculation detached from economic reality. Anyone who bought silver will be painted as a reckless gambler. The Commodity Futures Trading Commission will be cast as the calm, responsible adult protecting the public. This is gaslighting on a national scale. They need you to believe you were wrong to doubt the existence of a real shortage and to think the government saved you from yourself. If you believe that narrative, you will sell. You will hand over physical metal at artificially suppressed prices and give up the silver they urgently need. Don't fall for it. Coordinated national campaigns are not launched to stop bubbles. Bubbles collapse on their own. Coordinated campaigns exist to suppress uncomfortable truths and force capitulation through psychology, not fundamentals. The deployment of every weapon, regulatory, legal, and media, reveals fear not confidence. You are not losing. They need you to think you are. History shows intervention almost always backfires. In 1971, the gold window closed and gold surged. In 1933, gold was confiscated and revalued higher. Suppression works temporarily, never permanently. In 1980, silver collapsed under liquidation rules, yet later returned to prior highs. In 2008, short-selling bans failed to stop collapse. In 2020, buy buttons were shut off, delaying but not preventing rebounds. Every intervention rescues banks, not markets. Reality is postponed, not erased. Fundamentals always reassert themselves once control mechanisms weaken. Here, the fundamental reality is a physical silver shortage. You cannot legislate geology or outlaw supply and demand. Solar panels, smartphones, and modern electronics require silver. It cannot be printed into existence. Paper prices can be distorted, futures, liquidated, and narratives shaped, but real-world demand continues regardless of regulatory pressure. That is why the CFTC emergency meeting is an admission of defeat dressed as regulation. Over the next 72 hours, key signals matter: weekend leaks from unnamed officials, sudden margin hikes by CME Group, bearish bank analyst, notes preparing a narrative, and widening Shanghai or London premiums, signaling buyers. Front-running restrictions. They're positioning ahead of a potential U.S. market lockdown. That brings us to signal 5. Watch physical dealer premiums closely. If premiums jump from around $12 to $18 or even $20 on Sunday or Monday, that's dealers pricing in disruption. Dealers raise prices when they expect demand to surge before restrictions hit. Together, these signals confirm whether the framework is unfolding. Now, let's address the timing. Why is this happening right now? The answer is Friday's options expiration. On Friday, December 20th, roughly 40000 call options with a $70 strike expire. If silver is above $70 at 4 p.m., those calls finish in the money, forcing delivery of roughly 200 million ounces of silver the banks do not have. That delivery obligation is the problem. So the banks call the Commodity Futures Trading Commission and say the quiet part out loud: there is a delivery crisis on Friday. The solution is regulatory timing. Announce restrictions Thursday morning. Pressure prices lower Thursday afternoon. By Friday, silver trades below $70, options expire worthless, and the banks escape the squeeze entirely. A CFTC meeting scheduled just 2 days before options expiration is not accidental. It is coordination. Regulatory capture is complete. The CFTC is not policing the market, it is acting as an enforcement arm for institutions like JP Chase. This is happening in plain sight because they assume most people will not connect the dots. Prove them wrong by understanding the sequence. Here is the final guidance for the next 72 hours. If you are holding cash and want silver exposure, prioritize physical metal this weekend. Coins, bars, rounds, whatever is available. Buy locally if possible to avoid shipping delays. If local inventory is gone, order online by Monday at the latest before supply tightens further. If your exposure is paper, ETFs, futures, or options, you must decide by Wednesday. Either accept the risk of restrictions and forced liquidation, or step aside and rotate into physical metal or markets outside U.S. jurisdiction. There is no neutral middle position. Waiting passively exposes you to decisions made entirely outside your control once rules change. If you already own physical silver, the message is simple: hold. Ignore short-term price swings, headlines, and regulatory noise. What is coming is the system acknowledging you were right. Rules only change when the structure is under strain. That is not a moment to sell. It is a moment to tighten your grip and let fundamentals assert themselves. If you are invested in silver miners, remember this distinction. Futures restrictions do not change what miners produce. They sell physical metal. If prices decouple 50 on paper and 80 in the physical market, miners get paid closer to 80. Their margins expand dramatically. For those unable to access physical silver, miners may offer indirect exposure. For everyone else watching, there is a lesson. Governments intervene when markets are breaking, not when they function. They do not rescue systems that work. Right now, the paper silver market is failing. COMEX is failing. The manipulation scheme is failing. The CFTC's emergency meeting is the white flag, signaling structural stress, not stability. On February 2nd, 2026, at 9 a.m. Eastern Time, the CFTC convenes. By midday, rules change. By the close paper, prices may collapse. Physical markets respond differently. Price discovery shifts offshore into private channels. This is not the end of silver. It is the beginning of the end for paper pricing. Shortage is winning.